Welcome back. This is Jacob Milliken at 9M Investments, and today I'm going to be going through ETF flows for the month of July. So let's jump into it. Flows by asset class. The equities over this last month finally pushed through and now are leading on the year when it comes to fixed income. All the way through June, fixed income had led the way. But as you can see over this last month, big push by investors into equities really kind of blew the doors off on fixed income. But these are also just big numbers on a monthly basis altogether. So even though equities kind of took the lion's share here, 20 billion going into fixed income is also a fairly big number on a monthly basis. So again, investors taking money off the sidelines, putting it back to work, whether that be fixed income or equities, big numbers going to work this past month. Jumping over into the peer groups, where was that going? Mostly North American equities. But as you can see, fixed income, corporate high yields, that's a huge number on a monthly basis, although that's come down a little bit over the last week and day. Fixed income broad, global equities, North American against more financials, industrials, more fixed income, some energy in here. Not huge numbers on the month. Again, most of it is just that broad equity, which, when you really kind of dig into the individual names, that primarily means S&P 500 is where that is going. And so if you look at the individuals' names over the last month, S&P 500, BlackRock's iShares took in 10 billion, Vanguard's version took in 9.6 billion, QQQ took in 6.3. Again, QQQ is always a good one. We'll kind of give an idea of how investors are feeling from a risk standpoint. So, again, kind of risk on last month. Although I say risk on, this fourth one here, 4.7 billion into Tilt, which is a fund focused on 20-year plus treasuries. That's an interesting, all the big investment houses this year were saying, hey, you really need to start looking past, 1 year, 2 year in duration. I don't think any of them thought 20 plus years, but that is no less where money has gone. Where are they pulling from? Short-term bonds, short-term treasuries over this last month. Again, I think there's still some room there. You can still get some very nice yields. 6-month treasuries right over 5.5% this morning. Looking at over the last week, again, big moves over this last week. So you look at it from last month, 4.7 into treasuries. Just within the last week, 3.1 billion of that was going into this treasury bond over the last week. So again, people want to take advantage of the treasury rates at that 20-year rate. I'll jump into that here in a little bit more. Again, mostly S&P 500 type funds, some equal weight 500 funds, more diversified look, if you will, of where that money has gone kind of over the last week. On the year, again, Vanguard 500, S&P 500 fund, the VOO, is taking the lion's share, $22 billion on the year. Again, Tilt, 14.8 billion. So people going up the duration in the treasuries, and I guess looking to lock in that 20-year rate. JEPI, again, one of the ones that I use in my portfolio, is taking in a good amount. Bonds, people jumping back in bonds, hoping you kind of, after last year, they're taking advantage of any kind of bounce there may be within those sectors, I guess. You always want to have that in your portfolio, but those are big moves into the ag, especially after last year. Looking at the yield curve here, I kind of want to show, so 6 month at 5.5, anything under 1 year is over 5.3. Looking at that treasury fund where 20-year plus, that is kind of the outlier on the curve. If you look at 10-year, 30-year, so to me, is that enough of a bounce or a miscalculation where you want to take advantage of it and jump in? I don't know that for sure, but it is definitely kind of the anomaly here, and why people are, I assume, are putting money in toward that, looking at, coming down the mountain of the yield curve of rates coming down, lock in what you can. But we'll see where that goes, and something to kind of keep an eye on. I'm always interested to see what investors are thinking when they're putting into big numbers into a fund like that. And then lastly, looking at return on the year, I always kind of show this, just kind of give you an idea of what is actually the best and the worst of the ETF world. And so, as you can see, anything that is Bitcoin or crypto related, there's a few different strategies have done very well on the year. Up 60, almost 70%, 71% by Bitwise. Some of these semiconductors that have had a big bounce from last year, ARC Innovation, VanEck, SMH Fund. A lot of those are all driven by NVIDIA's big bounce on the year. You'd be surprised. A good portion of that return is all by one stock. What has done bad this year? Anything that has to do with cannabis is down 20-30%. And then some of these that are focused on carbon offsets, these absolute return funds, some of these kind of very esoteric funds have gotten killed this year. BDRI down 48%. This is a shipping fund that is very volatile from 1 week to the next. You can see it up 20-30% and down again on the year, down 48%. Natural gas fund down 49%. That is something I wouldn't expect to see, but again, always want to make sure this kind of gives you an idea why you want to have diversity. You want to make sure that you have all the different types of sectors, because if you have one area and you're putting all in on, you can get hurt very quickly, even in an ETF world. So always something to kind of keep an eye on. So anyway, I hope this was helpful. Kind of give you an idea of what happened in July, and we'll be covering everything in August and kind of keeping an eye on for you. And I hope you have a good week and a great August, and hopefully it stays cool or gets cooler. I don't think it's going to happen, but we try.